Good morning. My name is Dave Benson. I'm the president of DCB Insurance Services, located in El Segundo, California. Today, we're going to talk about how to enjoy your retirement safety and create tax-free income. I'd like to welcome all of you to our seminar and go through a few housekeeping items before we start. We're going to keep all of you muted throughout the presentation, but we will take questions at the end. So on your screen, there is a place to write down your questions. So please feel free to do so during the presentation. And then at the end, we will go through and answer as many questions as possible. If we don't get to all of your questions, we'll respond to them via email and send them to you at the end. So sit back and enjoy, and hopefully you'll get some good information out of this program. We're going to start by talking about how to build financial security. And I remember many, many years ago sitting in an office and having a financial planner talk to us about what people do with their paychecks. And there were actually three things that you can do with a paycheck when you get it. Item one is to spend money on things you enjoy. Item two is to pay your bills. And item three would be to save whatever money is left. And many people do things that way. I was one of those people that was doing that with my check. And then the person running the event said, all of you people are doomed to fail. Here is what you need to do with every paycheck that you get. The first thing you do when you get a paycheck is take a portion of it and put it in the bank. Doesn't matter what you put it in. It could be a regular savings account or anything else, but save your money. Then pay your bills. And then the third thing you do is use the remainder of the money for things you enjoy doing. So if you follow that formula, I don't care if you get a $1 check, if you take 20 cents of it or 10 cents and get in the habit of putting it in the bank, you will be amazed at how much money you will have extra at the end of the year. Now today, our focus is going to be on retirement income. And there are two types of retirement income. Taxable income, that's where you take money, put it into a qualified retirement account, such as an IRA, a SEP, which is a Simplified Employee Pension Plan for independent contractors or self-employed folks, a 401k, a 403b for school teachers or government employees, or just a pension plan. And when you put a contribution into your qualified plan, you take a deduction that year. But when you take the money out at retirement time, it's fully taxable. The second type of income that you can create is tax-free income. This is where you take after-tax money and put it into a retirement plan, such as a Roth IRA. And when you take the money out, you can take it out tax-free. Now let's talk about taxable income for a moment. All contributions to qualified retirement plans are deducted from your gross income. Let me give an example here. I'm having a little problem here with my screen. Bear with me here for a moment. Hang on one quick second. Okay, sorry about that little technical difficulty. Let's give an example. Let's say your gross income is $100,000 and you're going to put $10,000 into your qualified retirement plan. You're going to pay income tax on $90,000. And let's just assume for a moment that you're in a 25% federal tax bracket. So that means on that $10,000 that you were able to deduct from your gross income, you're going to save 25% of that. So you're going to have a $2,500 savings on that $10,000 on your taxes. Now, when you put money into a qualified retirement plan, whoops, we seem to have a little problem here. All of your when you put your money into your contributions into your qualified plan, you could put in money each year. In some instances, your employer will put in some matching dollars on a 401k. So a lot of times, if you are putting money into a qualified plan, you definitely want to put in up to the maximum that the employer is matching in your qualified plan. And then we can look at how to create some tax-free income with the difference. Okay, now let's say you're making contributions to a qualified plan over 30 years, and every year you put some money into your plan, and so you're taking a deduction. When you start taking the money out during the retirement years, within the first 7 to 8 years, you will have paid back all of the deductions, all of the tax savings that you had on those deductions every year. And the reason that will happen is when you take money out of a qualified retirement plan, the plan will determine what your life expectancy is by using government tables. So let's say that the average male lives to 78 and the average female lives to 80. Well, if you're going to retire at 65, that means they're going to calculate the payments that you get based on a 15-year life expectancy. So each year, you will be taking out more than what you contributed each year. And that's why within 7 to 8 years, you will pay back all of the money, all of the tax savings that you got over all of the years that you were making contributions to your plan. Now, when you have a qualified plan, you cannot take distributions prior to age 59 and a half. The only exception to that is if you are totally disabled or, God forbid, you died, then of course the money would be available to your beneficiary. And if in today's world, a lot of people are working beyond age 65, Social Security retirement starts at 67, but you must start taking distributions by age 70 and a half. If you do not do that, it will result in a 50% penalty every year that's imposed by the IRS. Now, the problem is if you have money in a qualified plan and you're not ready to retire by 70 and a half, you still have to start taking distributions from your qualified retirement plan. So that's something important to keep in mind. And as I mentioned a minute ago, the distributions are made based on your life expectancy. How many of you can tell me what day you're going to die? I bet none of you can answer that question. Because we don't know when you're going to die, we have to be prepared for living to a nice old age where you might outlive your money. And the key is you have to be able to plan accordingly so you can cover your living expenses for the rest of your life. Well, what steps can you take to guarantee that you will not outlive your money? That's a big concern because many people do, and then you have very little to get by on during the latter part of your life. So, what plan do you have in place to cover your living expenses if you outlive your money? That's a real serious question that you have to work on with your financial planner. Okay, now let's talk about some other things that we can do. When you put your money into a retirement account, there are different types of investments that you can put your money into, such as stock funds, bond funds, mutual funds, real estate, blended funds. And if you're going to put your money into high risk investments, you can make a great return on your money. You can also take a huge financial loss if that investment goes down. So, what I'd like all of you to do who currently have money in some kind of a retirement plan, look at the investments that you currently have and go back over any 10-year period of time. Go back from today over the last 10 years. Go back from 2005 to 1995. Pick any 10-year period. And what you will find is that with any type of stock fund, bond fund, mutual fund, you will have up years and down years. When you have up years, you can make some really good gains. When you have down years, you're going to take a loss. And the key is if you take a huge financial loss, are you going to have enough working years to make that money back? Especially if you're in your 50s or 60s right now and you take a huge financial loss, that's a serious problem. If you're in your 20s or 30s, not as bad because you have time to make that money back. So that's something that you have to look at when you're planning what type of investments to put your money into. So these are things that we've talked about. Now, if you put your money into low risk investments such as CDs or money market accounts or passbook savings accounts, in today's world, you're going to be earning a whopping 1/4 to 1/2%. How many years is it going to take you to hit your financial goals for retirement when you're earning 1/4 to 1/2% on your money? You might have to live a few hundred years. Now, let's talk about a different type of investment at retirement time, and that is an investment that creates tax-free money at retirement. The first thing that comes along is a Roth IRA. Now, you could set up a Roth IRA through a bank. The problem is when you get to retirement age, the bank is going to say, okay, life expectancy is 78 for a male, 80 for a female. And those numbers might be slightly different today, but I'm just using those as an example. So if you're a woman and you're going to retire at 65 and your money's in a Roth IRA with a bank, then you've got 15 years. So they're going to take all the money in there, divide it by 15 years, and do some few calculations to deal with compounding interest on your money. But your money will be gone by age 80. And if you live to age 90, you're out of luck because you can outlive your money when it's in a Roth IRA through a bank. When you take that same Roth IRA and you put it into an insurance company instead of a bank, it goes into what's called an annuity. And there are many different types of annuities that we could talk about on a one-on-one conversation. But the difference is they calculate your retirement income the same way. The money will be paid out over the same 15-year period, but you can't outlive your money. Because if you get to age 80 and that bank account or that Roth IRA account through the insurance company gets down to zero, the insurance company is going to guarantee you that same income for the rest of your life. Even if you live to age 100, the bank or the insurance company will continue to pay you, so you cannot outlive your money. Now, with a Roth IRA, contributions are made with after-tax dollars. You do not get to deduct the money you put in each year. The distributions are tax-free. You can take out your contributions, so the money you put in each year, you can take that out anytime, tax-free and penalty-free. However, the earnings, which is the interest that you make on your Roth IRA, you must keep that money in the account for a minimum of 5 years and be age 59 and a half to take the money out tax-free and penalty-free. So there are two components to the Roth IRA. The first part is the money that you put in each year. So let's say you're putting in $5,500 every year into your Roth IRA. That is your contribution. But the growth on that money, from the interest that's accumulating, that is the part that you cannot touch till age 59 and a half, or until that money's been in there for a minimum of 5 years. Now, of course, there's always a penalty exception for death or disability. The maximum that you can contribute each year, well, at least in 2015, is $5,500. $6,500 if you were age 50 or older by the end of 2015. You must meet certain income requirements to contribute to a Roth IRA. If your income is below a certain level, you cannot contribute. If your income exceeds a certain level, you cannot make contributions to a Roth IRA. Now, for those of you who are self-employed and are able to contribute a lot more than $5,500 a year to your retirement plan, a Roth IRA might not be the right answer for you. For those of you who feel that $5,500 or less is what you're going to contribute each year, then a Roth IRA might be a good fit. Let's talk about a different type of investment for retirement that creates tax-free income. There's something called an indexed life insurance policy. And with the index product, the premiums that you pay each year are done using after-tax dollars. Now, if you have a C corporation, and this only works with a C corp, there is something called a Section 162 bonus. Section 162 is part of the IRS code, and bonuses to corporate officers are completely above board as long as they are reasonable based on your compensation. Now, if you're making $100,000 a year and you take out a $95,000 bonus, that is not reasonable. But if you take out a bonus up to 20 or 25% of your income, that is deemed reasonable. Bonuses are taxable income to the shareholder that's getting those, or the corporate officer. So what you do, let's say you take out a $20,000 bonus and you're going to pay tax on that. And I'm just going to make up a number. Let's say the tax is $5,000. Well, you would take a bonus of $25,000. Take $5,000, use it to cover the tax on that money. Take the other $20,000 and you can put it in to your policy to cover the premium. Your corporation, based on the corporate tax bracket, will take a write-off on that $25,000 bonus. So that is the one way where you can get a write-off and still use after-tax dollars, because you write a personal check to cover the premium. I know that one's kind of complicated, but we can, if you have any questions on that, write them down and we'll address that afterwards. Now, the Section 162 bonus does not work with an S Corp or an LLC. It only works if you're set up as a C corporation. Now, with the index product, when you take out money at retirement time, it is tax-free income. The average interest rate paid over the last 10 years on the index life product is 8.1%, which is really good because interest rates have not been very high over the last 10 years. And investments that have safety features built in are paying very low interest rates. Having a little glitch here with the system. Bear with me here for a moment. Sorry. Okay. So, wait, are we in the right place here? Okay. Let me get back to where we were. Somehow the screen shifted here and I ended up back in a different place. So let me get back to where we were a minute ago. We were talking about the interest rate being 8.1% over the last 10 years. We can't guarantee what interest rates are going to do over the next 10 years, but the insurance companies have money managers that manage all of the premium dollars that are coming in. And you cannot, with this program, you cannot outlive your, you cannot outlive your money if the plan is set up correctly. Even if the interest rate drops a little bit, more than likely we're going to see interest rate returns in the 6 to 8% range over the years. And when we put calculations together on this program, we make sure we're very, very conservative when we're showing this to you to make sure that the money that will be accumulated will be realistic, not some far-fetched number that is not going to be achievable. Now, premium dollars are invested by the money managers at the insurance companies in blended funds, and those funds are changing by the minute as the money managers see that a fund is not performing well. They move that money to other funds, and they have been very, very successful in getting high rates of interest. 8.1% is huge. And as we mentioned, the interest rates will vary from year to year. Now, there are some safety features built into this plan, because as I mentioned before, if you're in your 50s or early 60s, you cannot afford to take a huge financial loss if the investment goes down. Interest rates on this product are capped between 12 and 14%. And the last time we saw interest rates at that level was back in the early 1980s. Well, if all of a sudden an interest rate shot up to 15% and your plan has a cap of 12, you will get at most 12%. But the likelihood of us hitting those type of interest rates again are extremely low. Now, in years where interest rates go up, you're going to keep the gain. In years where interest rates go down, you do not take a loss. You just get zero that year. Let me give you an example. Should be here. Let's say that you have $1,000 in an indexed savings account, and over the years, you've gained $500. So you're now up to $1,500 in your savings account. And let's say the next year we have a bad year and it's a down year, and your plan takes a $600 loss. With most investments, you would have a $900 balance in your account. With the index plan, because you do not take a loss, your account balance stays at $1,500. So that's where the safety features come in. You never take a loss. So if we have over a 10-year period, 7 or 8 up years and a couple of down years, in those down years, you just get zero that year. You never take a loss. And that is a huge feature that is not included in a stock fund, a bond fund, or a mutual fund. Now, if you're doing the index product, you must leave your money in the account for a minimum of 10 years. And you can retire at any age. If you start this plan early, you could take the money out before age 59 and a half with no penalties. If you're like me and you're a workaholic and you have no plans to retire and you're going to be working at age 70 and a half, you do not have to take the money out unless you want to. So you can leave the money in there and never take it out. You can take it out at age 50 if you choose, as long as you have 10 years of contributions into the plan. Now, because this is an indexed life insurance plan, there is a death benefit and a savings account affiliated with this plan. So if you do not make it to the retirement years, your beneficiary will not only get the death benefit, they will also get the money that's in your savings account. And if you do make it to retirement, here's what's going to happen. Each year, when you take money out of the account, you're going to do so by taking a loan out of your policy. Because once your policy is 10 years old, when you take out a loan, you pay zero interest. So each year you're going to take money out, and we are going to make sure that there is enough money in there for you to take out a decent income every year for the rest of your life. Now, let's take a minute, and the loans are not taxable. That's how you get tax-free income. And as I mentioned, there's zero interest on the loans after 10 years. Now, if for some reason you take some money out during policy years 1 through 10, then you're going to pay 2% interest on the distributions that you take out. But we strongly recommend that if you're going to set up this kind of a plan, you leave the money in there for at least 10 years. Now, let's talk about if you die while with this plan. The beneficiary, and let's say that you die after you start taking money out during the retirement years. Let's say you have $1 million death benefit and you're taking out $50,000 a year from the policy. And let's say you've taken out $50,000 for 4 years. So that's $200,000. And then you die. Your beneficiary will get the $1 million less the $200,000 that you've taken out. So your beneficiary would get $800,000. Now, there's another interesting component to this program. For people that have net worth of $1 million or more, not including your primary residence, we actually have a special premium financing program available through Wells Fargo Bank. And the way it works is the bank will finance 80% of your retirement income for 10 years. So in policy years 1 through 10, you will contribute a minimum of $20,000 a year. The bank will put in $100,000 a year for 10 years. So if you're putting in 20,000 and the bank is putting in 100,000, now each year for 10 years, you've got $120,000 going into your retirement account. In years 11 and 12, so this is policy years 11 and 12, Wells Fargo is going to get their money back because we're going to take that money out of the cash value that's accumulated in your savings account. Not only will they get their money back, but they will make some interest. They get LIBOR plus 1%. And whatever that comes out to is the interest that will be paid back. Now, the question that would come up is, well, if we pay them back all the money they put in years 11 and 12, will I have enough money left in that account to fund my retirement? And the answer is yes. You will have a lot more money than if you would just put in $20,000 a year. And so what will end up happening is beginning in policy year 13 or later, depending how long you want to wait, the longer you wait, the more income you will have to take out of the policy. And what we will do, for those of you who are interested in looking at this type of a program, we will prepare quotes for you to take a look at where you will see exactly how much money's there based on different assumed interest rates. As I mentioned before, over the last 10 years, interest rates have been averaging a little over 8%. When we demonstrate this for you, we're going to demonstrate it at the 6 to 7% range, so you will see realistic numbers on how much money you will have available to take out. And remember, with this type of a program, the money you're taking out is tax-free. With the money that's in your 401k or your IRAs or your Simplified Employee Pension Plan or your company's profit sharing plan, that money is fully taxable. So about a fourth to half of the money in your retirement plan is going to Uncle Sam. So when you hit retirement age, if you're thinking, I have to have X amount of money in my retirement account to maintain my present lifestyle during my retirement years, you have to add an extra 25 to 50% to that in order to meet your financial goals, because you're sharing that money with Uncle Sam. With this program, with the qualified life insurance policy, because the distributions are tax-free, you're keeping 100% of the money that you take out. You're not sharing it with Uncle Sam. And remember, you cannot outlive your money. So this is a great alternative. Now, I mentioned before that if you have a qualified retirement plan through your employer, like a 401k, and the employer is putting in matching dollars to what you're contributing, you definitely want to continue to put money into your qualified retirement plan up to the company match. But anything above that you want to put away for retirement, you should look at a tax-free investment, whether it's a Roth IRA or it's an indexed life insurance policy. Because with both of these, if they're structured correctly, you can create an income stream that you cannot outlive. So that income will be there for the rest of your life. Now let's talk about next steps. If you want to find out if you can qualify for one of these tax-free retirement plan options, please call my office at 310-215-1222 to schedule an appointment so we can review your options. Not everybody will qualify for the indexed life insurance policy. So we want to have a conversation to see if you do qualify, and we can move on from there. So at this point, what we're going to do is take time to answer your questions. And the first question that we got is, does this program, does this does the index life insurance policy replace my current retirement plan? And the answer is no. You still keep your qualified retirement plan, and you do this as a second plan. So all you're doing is, instead of putting all of your money into bucket A, you're taking some money and putting it into bucket A, which is your qualified plan, and you're putting the balance into bucket B, which will create tax-free income. So it doesn't matter if it's the Roth IRA or it's the index life insurance policy. Both of these have safety features built in and will help you create more money at retirement time because you're getting tax-free income. Next question. Can I take money out before the 10th year from my index life insurance policy? Well, the answer is yes, but you're going to pay 2% interest when you borrow money out of your account prior to the 10th year. It will also, if you're taking money out in policy years 1 through 10, you will definitely not have as much money available for you when you want to start taking money out during the retirement years. So we strongly suggest that you leave the money in there for at least 10 years. Next question. What are the guarantees in the policy? The interest rate on the index life insurance policy has a minimum guarantee of 3%. Now, the interest rates since the index product started about 15 years ago have never gone below 6%. They've always been up there. And like I said, over the last 10 years, the interest rates have averaged over 8%. But the insurance companies also have what's called a guarantee fund that will guarantee up to $250,000 in your policy. It's just like banks have your money insured up to $100,000. Insurance companies guarantee your money up to $250,000 in the event an insurance company went bankrupt. And by the way, the insurance companies we work with are highly rated with all 5 of the major rating agencies. We only work with companies that have A or A plus ratings by AM Best and with Moody's, Duff and Phelps, and the other rating agencies. What happens if I can't make a payment one year? You're going along, you're putting money into your index policy and all of a sudden you have a bad year and you can't put money in. If the policy is more than, say, 3 or 4 years old, you should have enough money in there to keep the policy going. But that is a question that we will address on a one-on-one basis. You can also put in, the beauty with the index product is you can vary the amount of money that goes into the policy each year. This is something that I should have addressed before. Let's say that your policy is set up with a $500,000 death benefit. We don't have a set premium. We have a range of premium. So let's say on the low end, it's $2,000 a year. And keep in mind, I'm just making up numbers. And on the high end, it's $20,000 a year. Well, if you're putting in closer to $2,000 a year, you're at the minimum that you can put in. And if interest rates on your savings account in the policy go down and you're at the very minimum level, you might have to add more money into the policy. But if you're putting in closer to the high end, which is the way we structure this, the bulk of the money is going into your savings account. And that way, if you're up at the higher end of the spectrum with your premium payments, then if you miss a year, it's not a big deal because you have enough extra money in the policy. Now, another question was, how does the death benefit work? And we touched on this before, but I want to touch on it again. If you die during the first 10 years while you're putting money into your policy, your beneficiary will get the death benefit. And if you qualify for the program with Wells Fargo, where they're contributing money into your policy and you die, the bank will be repaid the money that it put in, and then the balance of the death benefit will go to your beneficiary. If you die after you start taking money out of the policy, your beneficiary will get the death benefit less what you've withdrawn as retirement income. And then the next question was, should I keep my Roth IRA at the bank? Well, you have to remember, if you have a Roth IRA and it's at a bank like a Wells Fargo, a B of A, Chase, or any of the other banks, once all of that money is withdrawn during the retirement years and you're still living, once all the money's withdrawn, you're out of luck. That income stream is gone. Where if you take that same money and we transfer it to a Roth IRA through an insurance company, you cannot outlive your money. If the money runs out at age 80 and you live to age 106, you will be guaranteed that same income that you were getting up to age 80 till age 106. Next question. I was under the impression that you could leave your Roth sit as long as you wanted to without having to take withdrawals. That is correct. You can leave your Roth IRA in beyond age 70 and a half. So you are correct with that option. That concludes the questions, and what we will be doing is we will be posting this webinar on our website at www.dcbinsurance.com. Again, www.dcbinsurance.com. And again, if you have questions or you would like to discuss your personal situation with me, please call us at 310-215-1222. and ask my office manager, Estella, to schedule an appointment so we can talk about your specific needs. I want to thank all of you for being here today and have a great day.